Section 1. The first step is always the hardest. Investing can feel like a world reserved for experts. You hear complex terms on the news. You see charts with lines going up and down. But that is not true. The world of investing is more accessible today than it has ever been before. You do not need a lot of money to start. You do not need to be a genius. You just need a little bit of knowledge. You just need the willingness to take a small, manageable first step. The goal is not to get rich overnight. The goal is to begin. This guide is designed to do one simple thing. It will walk you through the exact steps to make your first investment. A few simple words. Before we move forward, we should define a few simple words. These terms might sound complicated, but the ideas behind them are quite straightforward. These are the basic building blocks of everything we will discuss. First, let's talk about a stock. When you buy a stock, you are buying a tiny piece of a company. Imagine a company is a large pizza. Buying one share of its stock is like buying one very small slice of that pizza. If the company does well and makes a lot of money, the value of your slice might go up. Next is the stock market. This is not a physical place anymore. It is a giant network where all those slices of pizza, the stocks, are bought and sold. Think of it like a huge online marketplace, like eBay or Amazon, but for company ownership. The power of a long runway, time horizon. Your time horizon is simply the length of time you expect to keep your money invested. This concept is one of the most powerful forces that will shape your investment strategy. Time is the fuel for your financial engine. How much can you stomach? Your risk tolerance. Now we need to talk about you, specifically your feelings. Investing is not just about numbers and charts. It is deeply emotional. Risk tolerance is a personal spectrum. Some people are natural thrill seekers. There is a force in finance so powerful that Albert Einstein supposedly called it the eighth wonder of the world. It is called compound interest. Compounding is the process of your earnings generating their own earnings. It creates a snowball effect. Your money starts to grow at an accelerating rate over time. Now that we have laid the foundation, it is time to look at the menu. What can you actually buy with your money? For a beginner, you only need to understand a few basic categories. Think of the investment world like a giant grocery store. There are many aisles, each with different types of products. If buying an individual stock is like buying a single slice of pizza, you are making a highly concentrated bet. If you are right, and the company performs exceptionally well, your potential for reward can be very high. When you own shares in just one company, all of your eggs are in that one basket. Imagine you could take the best features of an individual stock in a mutual fund and combine them. What you would get is an exchange-traded fund, or ETF. Like a mutual fund, an ETF is a collection of many different investments, giving you instant diversification. Here is the key difference. An ETF trades on a stock exchange just like an individual stock. Picking your broker, what matters most. Once you know the account type, choose a brokerage firm to open it with. 20 years ago, trading costs made this a huge decision. Today, competition is fierce, which is great news for you. Still, a few key factors matter for beginners. Opening the doors, your account setup. You have chosen a brokerage firm and the type of account you want to open. Now it's time to actually set it up. Do not be nervous. It's straightforward and like opening a bank account online. You'll need a few key pieces of personal information. The whole process usually takes about 15 minutes. The moment has arrived. You have done the foundational work. All the preparation has led to this single, simple action. It is time to place your first trade. This can feel momentous. It marks your transition from a saver to an investor. But it's actually simple, just a few clicks. We'll demystify it and show you what to expect. Now that you have made your first trade, a new question naturally arises. How much should you invest in the future, and how often? The answer is dollar cost averaging. It removes emotion from the equation and builds discipline over time. Dollar cost averaging means investing a fixed amount at regular intervals, no matter what the market does. Once you are an investor, you will become acutely aware of something called market volatility. This is the natural up and down movement of the stock market. The most important rule is, do not panic. Remember your time horizon. If you are investing for a goal that is decades away, what the market does this month or this year is just noise. The journey's first step. We have reached the end of this guide, but it is the beginning of your journey. The path to becoming an investor can seem long and full of complex turns. The goal was to show the first step is manageable and simple. This knowledge is the true return on your first $100 investment, and it will compound for the rest of your life. Your path from this point forward. You are now equipped with the knowledge and the confidence to take control of your financial future. The question is, what should you do next? Here are a few clear, immediate next steps you can take, starting today. You have laid the foundation. The perfect time is now. Taking this step makes everything else real and possible.